Why now is the perfect time for emerging markets? The dollar's weakness has historically been a boon for emerging markets, and the current economic climate suggests this pattern may repeat. With the dollar softening and conditions improving across many emerging economies, it's an opportune moment to explore investment opportunities. Here's why this matters and where the potential lies. The dollar's weakness, a historical advantage. Over the past 3 decades, periods of dollar weakness have coincided with strong returns for emerging markets. When the dollar weakens, capital tends to shift from the US to global markets, including emerging economies. This shift brings several benefits. Stronger currencies. Emerging economies often experience stronger currencies as their value appreciates relative to the weakening dollar. Lower import costs. With a stronger currency, import costs decrease, boosting domestic growth. Easier financial conditions. The financial landscape becomes more favorable, making it easier for businesses to borrow and invest. This combination has historically led to a powerful boost in both domestic growth and asset prices in emerging markets. Current conditions. A repeat of history? Today, we see similar conditions emerging. Inflation easing. Inflationary pressures are decreasing, providing a more stable environment for economic growth. Relatively high interest rates. Interest rates remain relatively high, giving central banks the flexibility to support growth if needed. Central banks with room to maneuver. Central banks have the capacity to implement policies that further stimulate economic activity. Emerging markets. A discounted opportunity. Despite these positive factors, emerging market, EM, equities are still trading at a significant discount to developed market levels. This presents a unique opportunity for investors. Return potential. Investors can capitalize on the potential for strong returns as emerging markets catch up with developed markets. Portfolio diversification. Adding emerging market investments provides diversification, reducing overall portfolio risk. Where to find opportunities. Emerging markets can be categorized based on their structural positioning. Deep market countries. Taiwan, Korea, Hong Kong, and the UAE boast well-developed financial markets. Their currencies have strengthened with the dollar's decline, but their reliance on exports may limit short-term gains. Dollar-anchored economies. Saudi Arabia, Thailand, and Malaysia hold substantial dollar savings but manage their exchange rates tightly against the dollar. Their prospects are closely tied to external dollar movements. Borrower nations. Brazil, Mexico, Indonesia, and India are well-positioned to benefit. Stronger currencies and lower inflation allow central banks to cut rates, creating a favorable environment for equities. China. China's currency is tightly managed, reducing sensitivity to external factors. The outlook depends on the scale of stimulus implemented by policymakers. The case for investors. Despite faster economic growth in emerging markets over the past decade, equity market returns have lagged. This lag is consistent with the cyclical nature of emerging market equity returns. The current dollar weakness and improving conditions suggest a potential repeat of the historical pattern, offering investors a unique opportunity. Ada Chan, Senior Fund Manager of JOHCM Global Emerging Markets Opportunities, emphasizes that while these insights provide a perspective, they should not be taken as investment advice. The market's future is uncertain, and individual circumstances vary, so thorough research and consultation with financial advisors are essential.